everyone, Corey here with the Cyclical Investors Club YouTube channel. And this week we're talking about highly cyclical stocks, and the specific stock we're going to talk about in this video is Carnival Cruise Lines. And it's going to be a highly cyclical stock that I would suggest avoiding this cycle, mostly because I think that the recovery is going to be a lot slower this time around than it has been in the past. So well, we're going to get into that, and I'm going to show you kind of what I'm looking at in just a second, right after this disclaimer.
Hello everyone, and welcome to the Cyclical Investors Club YouTube channel. My name is Corey Kramer, and this is a channel where I share my investing process and strategies using examples of stocks that comprise the S&P 500 index. These videos are for educational purposes only and are not personal investing advice. If you would like to receive analysis on stocks that are not part of the S&P 500 index, as well as receive additional in-depth portfolio strategies, consider joining the Cyclical Investors Club Premium service. It has produced market-beating ideas and strategies, costs less than $30 per month, and it helps support the investor education and research that I share with the public. All right, everyone, before we get into Carnival Cruise Lines and why I think it's an S&P stock to be avoided this week, let's take a look at the performance of the other three avoid suggestions that we've had so far this year. We're only about 4 weeks in, so we've only had 3 other stocks I've suggested avoid. So just to recap, these are stocks to avoid for reasons other than just simple valuation reasons. I have a separate category of stocks that I call sells for stocks that are quality companies that are just maybe overpriced. Okay, so with these, there's something else going on usually that might cause you to avoid them other than just the price. As we can see, the 3 stocks I suggested to avoid on the whole are negative by about 0.5%. That is due to IBM. They released earnings this week and revenues disappointed, as they have for the past several years, which is one of the reasons why we were avoiding it to begin with, and the price took a big dive, and that's reflected here. So you can see that you'd be down about 0.5% if you bought all 3 of these at the times that I suggested avoiding them, while the market was up 1.5%. So the relative underperformance is about 2% so far for this group, and after this week I'll add Carnival, and we'll begin to track that and see how it performs against the index. Okay, so Carnival Cruise Lines. These guys are sort of the epitome of the COVID problem with businesses. If you recall, back when COVID first started, one of their cruise ships had a major outbreak aboard it very early on, and people were quarantined, and it was just really a nightmare. Several of people died that were on board the cruise ship, and since then it's pretty much been nothing but downhill for Carnival. But before we even get into that, I actually wrote 1 or 2 articles, at least one for sure, where I was warning about just Carnival's normal cycles. Okay, so back in, I think it was about March or early April of 2018, right in this area, I warned Carnival investors in a Seeking Alpha article about what the potential downside could be for the stock, because as you can see, it looked very much like it was getting toward a cyclical peak. And it also looked very cheap, and everybody was writing bullish articles on stocks like Carnival, and I just really felt that people should be aware of the type of down cycles that they could face. And if you look from here until before COVID actually came, so this is 2019, we haven't even gotten, there's no COVID anywhere, right? So a person would have lost 30% if they were holding Carnival during this time period, and I warned people that could happen. So, and the reason that I knew that could happen is because I understood cycles. And if you go back to 2005 and 6, this was a very, and this pattern actually goes back a whole other cycle to 1998. it's not, this chart doesn't go back far enough. But if you do enough historical research, this is just a really great example. These are early decliners. They're leading cyclical indicators. Carnival and cruise lines are. So you'll see that it started to see weakness in late 2005. It had gotten ahead of itself, started to see weakness here. Now, we wouldn't actually have a full decline in the market until 3 years later, let's say 2 years later, okay? But we started to see it with Carnival when things kind of started to peak here, okay? But the stock price was anticipating this ahead of time. This is still 2007. Remember, the market didn't totally dive until about October of 2008. I mean, that's when things got nuts. Maybe September. So we're still not even to 2008 yet. So by halfway through 2008, the wider market's still near its highs. Okay, I mean, it's fallen a little bit, but it hasn't fallen that much. So, but if you look at from Carnival to there for those 3 years, you know, you're losing 12% a year, and this is while the regular stock market's still making new highs. All right. So it anticipates these down cycles well before they happen, and it did exactly the same thing right here, okay? And all I did was basically just warn people that, you know, look out below, this is probably coming. If you looked at their earnings, they're still rising, but the market is forward-looking. And sometimes it gets ahead of itself, and it does this too early, and then it has to recover. You started to see that happen right here before COVID hit, but they're relatively predictable. We actually see it happen here too. So earnings are actually still rising. The market predicted a downturn in 2016, if you remember that. So they started saying, okay, this is the end of the cycle. This is the end of the cycle. And a bunch of professional investors got out because they're usually the ones that get out early. And then they were wrong. They were early. And it still had several more years, and then you quickly see that rebound. So there's always a chance that you get it wrong. There was a chance I could have got it wrong. I ended up getting it right in this case, but I could have been wrong. I could have been saying that here and then have another leg up. But the point is, without COVID, Carnival was still a very difficult investment to make, even at lower prices. I wrote an article when it was about $40 per share after COVID was out, so maybe right in here. I think it was a little bit later, but maybe the price had jumped. And I said, not yet. Yes, the price has come down a lot. These guys have lots of problems ahead, and they're not going to be resolved soon. And then, you know, the stock's down 50% since then. Okay, so now the reason I wrote that article was because normally you might have wanted to start dipping your toes in at that point, but the problem with Carnival is that it takes a long time to recover. It took a long time in the last cycle to recover. This is a normal cycle, not a COVID. I mean, look at the difference. These guys were still making money here. They are losing money. They are losing lots and lots of money, and they're expected to keep losing money for the next basically two years. Okay, so we should understand that this cycle is way worse than any of the other cycles they had, and they didn't recover very quickly during the last cycles. So let's take a look at that. So this is the historical drawdown chart for Carnival's stock price. And we can see they have these very deep cycles. There's one early on here that's probably not quite as comparable, but because they're much bigger now. But I definitely think this down cycle and this down cycle are what we could have expected from a normal recessionary down cycle, okay? And let's look. This was like 2001 until the stock price fully recovered its old highs. It took 5 years. Now, we'll call it 4 to 5 years. From the start of the decline, which actually started in, that was from the bottom, but I usually measure it from the start of the decline. So from the start of the decline in 1998 to 2004 is about 6 years, okay? The next decline started in 2005. The stock price didn't fully recover for about 10 years, 9 or 10 years, okay? So these are really long cycles, and I prefer that cyclical stocks recover within 5 years. I have a few exceptions that I'm willing to make sometimes if it's a stock that normally has long cycles, but what I require in that case is to buy very deeply. If I'm buying at 70 or 80% off the highs, like right down at the very low, it's okay if it takes me 7 years to earn my money back because I'm going to like quadruple my money. That's okay. But I mean, I wait and wait and wait until they're super deep. I actually picked up, I think I only picked up 1 or 2 stocks that were 75 or 80% decliners back in March. But I did get a couple of them. And they might take a longer time to recover. I know one of them is up almost 140%. So it might take a little longer for them to recover their old highs. But when they do, it's worth it so if you buy low enough. Okay, so these are normal declines. Carnival's price right now is basically where you would expect at the bottom of a normal decline. But it's just not normal. I mean, they're in way, way worse shape. Basically, every few months, they're issuing new shares and they're diluting current shareholders to raise money. They're borrowing more money, and they're borrowing at expensive rates because lenders know that it's dangerous. Look how much debt they have compared to their market cap. Credit rating is only a B, okay? So it's not their fault. They didn't do anything wrong. It's just that their particular industry just was the worst industry to be in for a COVID-led decline. Now, all of this said, if the vaccine gets rolled out, if they start doing better business, it's entirely possible that this stock price doubles to $40 per share, okay? So I want to make that really clear. There's definitely upside potential here, but it's not the type of high quality upside potential that I look for. So I talked about Valero this week as that's totally different. Like, I know for sure that Valero isn't going bankrupt, basically. I don't know that for sure with Carnival. If anything basically else goes wrong, these guys will not their stock price will not recover for 10 or 20 years or 15 years, something like that. I mean, just way beyond my when I say recover, I mean recover their highs. So you're unlikely to see this at $70 per share again for at least 5 or 10 years if everything goes great. All right, so that's why I would avoid this one and not be sucked into trying to bottom pick this. You saw a lot of action down here from day traders, people trying to pick this bottom. And look, some people have probably bought down at like $10 and it's at $20 and they made 100%. That's very, very risky and hard to do. I like no risk in earning 100%, not like taking a lot of risk and earning 100%. So that's my take on Carnival and why it's going to go into the avoid spreadsheet moving forward. And we'll track it and see. It's definitely going to take some time for, I think, my thesis to play out because, like I said, this could see a big jump in price. It could go up 50% or something. But I think as time goes on, we'll see that the market, the wider market, the S&P 500 will outperform this stock over the next 5 to 10 years. All right, thanks for watching. And if you enjoyed the video, make sure to click subscribe. If you have any questions, go ahead and type them in the comment section, and I'll do my best to answer them. Later.